Hello and welcome. Today we have with us Nilesh Shah of Kotak AMC with us for a quick chat. Let me begin by asking you, Nilesh. We have now less than a month before the Lok Sabha elections are out. What if the Ab Ki Baar 400 Paar narrative does not play out? Will the markets be in more trouble than they are right now?
So market today is discounting continuity of government and continuity of reforms. Now, whether government continuity happens with 400 plus 400 minus, I don't think so. That's going to matter as long as there is continuity of government. The second and more important for the long term of the market is continuity of reform. India has done exceptionally well to move from 10th largest economy to be on course to become third largest economy globally. From being coach or dibba of the global growth train, now we have become engine along with China and US. From contributing low single digit to incremental global GDP growth, we have now started contributing high single digit. And that momentum, that growth requires reforms. Otherwise, we'll fall into middle income trap kind of countries. So as long as we get continuity of government and continuity of reforms, markets will be fine.
So if the markets are believing that the reforms will continue irrespective of the number of seats that the new government or the incumbent government will get, why the markets are feeling the heat right now? Is it because of the low voter turnout? Is it because of anything else? Is it because of any other global factor?
So one, market has been too optimistic about discounting all the future event. Fed has said I'm deferring rate cuts, but market is expecting eventually you will have to cut rates and it will be sooner rather than later. There is boiling tension in Middle East and Eastern Europe, but market is believing this will not impact availability of energies or price of energy. The corporate results so far has come in line with market expectation, and market is believing this will continue in next 4, 6, 8 quarters. There is election ahead, and market is expecting continuity of government and continuity of reform. So in some sense, market is discounting everything optimistically, and which is why it went up to 75,000 Sensex. Now, it is quite natural that when you're discounting everything optimistically, there is bound to be some jitters. And what kind of correction we are talking about? It's just 5% from the top. That's not a correction by any means. That's normal volatility which will happen in any market.
Okay, can you tell us the things that the markets are not discounting yet at the current levels?
So one, market is not discounting that reforms can really be unleashed in a manner which can change India's growth orbit from high single digit to double digit. Why is market not discounting this? Because market doesn't have visibility on it. Very rarely India has grown in double digit. But if we have to catch up with China, we have no option but to do it. Now, will new government unleash that kind of reforms? For example, Puneet, our manufacturing is uncompetitive to global peers because of higher logistics cost and higher power cost. It is reflected in our low share in export of goods. It is reflected in low share of industry in our GDP. Now, what can I do to unleash India's manufacturing entrepreneurship? The reason why my logistics cost is high is because passenger fare subsidy of railway passengers is loaded onto commercial freight. The reason why my power cost is high because free agriculture power subsidy is loaded into industrial power. If those subsidies, instead of getting loaded onto industry, aka manufacturing, gets loaded or absorbed in the budget, now that will make budget deficit high, that will make budget uneven. Well, now we have option of monetizing divestment because PSU market cap is up about 4 times in last 3 years. So can I see a reform where government says we will do more divestment, use that fund to absorb agriculture power subsidy and passenger fare subsidy, lower logistics and power cost for India so that our manufacturing becomes competitive? This is something which is not discounted by the market. If that happens, I have no doubt in my mind that India GDP growth will go double digit and market will start discounting that.
So, in terms of the clarity on reforms and crystal ball gazing, do you think there is some confusion as well in terms of how the markets are perceiving the narrative that is playing out right now in terms of the incumbent government? We agree that the the NDA government may return to power. Okay, but the narrative has, narrative over the first three phases has kept on changing from economic policies to Abki Baar 400 Paar to now Adani Ambani. So is there a mishmash of everything and that's why the markets are jittery? Because they're not getting a
So,
clear vision as to what the government will do once it's voted back to power.
so market is smart enough to discount that there are things which are said before election and then there is work done after election. Second, I don't expect that 5% movement in market can be called jittery. Well, that's normal behavior. Look at how our markets have delivered return. Last year, micro caps were up some 60-70%.
Correct.
You get that kind of return over 5-year period, not in 1 year. So this correction is a normal behavior of the market and it will be futile to link it with election jitters.
Okay. Okay. So how do you see the mid cap and small cap, basket play out in the next 1 year? Will it be another year of 1, 2, or 4?
So Puneet, by normally large cap trades at higher valuation, then mid cap, then small cap, then micro cap. Today we have micro caps trading at higher, then small cap, then mid cap, then large cap. This gap of large cap and micro cap is too wide. I mean, this is like expecting that Mohammad Azharuddin ने 3 century मारे थे in the beginning of his career, तो चौथे मैच में भी सेंचुरी मारेगा. और वीरेंद्र सहवाग स्कोर्ड अ ट्रिपल सेंचुरी, तो अब एक और ट्रिपल सेंचुरी मारेंगे. That doesn't happen. The valuations are very, very high in micro caps. It is above average in small and mid cap, and it is around average in large cap. My feeling is that over next 12, 18, 24 months, the return between large, mid, small, and micro will narrow down significantly in favor of large cap.
Which also means that the retail investors will probably take a backseat because they are the ones who are, investing in a huge quantity probably in the large and the micro caps and the small caps, because that's the go-to area as compared to the larger peers.
So again, Puneet bhai, what you've stated is absolutely right. But if I want to portray it in another context, there are experienced investors and there are inexperienced investors. Experienced investors cut across institutional as well as retail, but they are dominated by institutional investors. Inexperienced investors are institutional as well as retail, but they are dominated by retail investors. I think experienced investors are going for quality. Inexperienced investors are chasing momentum. Experienced investors are going for reasonable valuations. Inexperienced investors are just buying what is moving. Experienced investors have reshuffled their portfolio from micro caps, caps towards mid caps and large caps. Inexperienced money is still chasing micro caps and mini caps with the hope that they'll do well or they'll continue to do well. The experienced investors are investing based on fundamentals. Inexperienced investors are getting influenced by social media and other things. I think over a period of time, this inexperienced people will lose money and gain valuable experience and move to the tribe of experienced investors to become long-term investor.
Okay, so if the large caps are to do well, a lot of it has to do with the FI flows as well, because that's their go-to area as far as the Indian markets are concerned. So you expect the FI flows to pick up in the next 1 year or so?
So FPIs are in dilemma. Should they go towards cheaper market like China, Russia, Brazil, South Africa, Turkey, or should they go towards expensive market? China trades at one-third valuation of India, Russia at one-eighth valuation, Brazil at one-half valuation, South Africa at one-half valuation, Turkey at one-fourth valuation. So if you are focusing on cheaper market, there are plenty. In India, you have to come with conviction. It's an expensive market, but it has 5-year, 10-year, 15-year long-term potential. So my feeling is that the long-term investor will come to India. The momentum investor will probably book profit out of India to go into other markets. But as long as we do well, our earnings growth is better than our peers, our governance standards are better than our peers, and we convince the world that India is actually doing this growth with a green attachment, with retaining lowest per capita carbon emitter in the world, then this 3G of growth, governance, and green will ensure that foreigners continue to invest in India. Not only we have to do well, Puneet bhai, but others have to score badly. They have to score self-call. So Russia should remain entangled in Ukraine so that no global investor go to Russia. China should keep on talking about Taiwan so that global investors remain jittery over there. Brazil should have a communist government and their policy should be anti-industry, anti-investor so that people go there with jitter or people don't go there. So we have to do well and others have to score self-goal in order for us to get foreigners' money.
Okay. So is there any spaces within the market where you see some irrational exuberance building up?
Majority of low floating stock counters, whether it's in micro caps, mini caps, small caps, mid caps, their valuation looks way ahead of their fundamentals. Some of the counters are trading. A company whose salaries and wages cost is more than sales, they trade at 200 P. Some banks are trading at valuation at which they will never be able to raise capital in secondary market. Their valuations are today only because there is limited floating stock, 4%, 5%, 10%. With that floating stock, limited buying can impact prices heavily. But a bank cannot grow without access to capital. And at this prices, they will never get capital in secondary market. Correct. So low floating stock counter is where there is complete and irrational exuberance.
So talking about interest rates and these debt servicing per se, March 2024 quarter has not been, has seen a significant, any upgrade or downgrade by the brokerages. Can the corporate earnings be the next worry point for the markets? Because the interest rate narrative, the higher for longer narrative is still playing out as far as central banks are concerned.
So fortunately for India, corporate India is deleveraged. It's generating more and more cash. And there are some events which could impact corporate earnings positively, not negatively. For example, in IT sector, we believe there will be bunching up of orders. The order cycles from RFP to final order from 6-8 months have grown to 12-18 months. Now, could there be bunching up of orders in the next 6-12 months? There will be more volume for IT sector. The monsoon is expected to be good. That could boost agriculture and rural economy. FMCG could be beneficiary. Third, government, typically during election period, will not be able to take decisions and spend money. So there will be some slowdown in their spending. But post-election, they could be back to spending. Now, that boost can come in next 10 months. So put together between IT sector reviving, monsoon supporting rural economy and government unleashing next phase of reforms, corporate earnings would actually get supported on the higher side.
Okay. You talked about the rural economy. There are some reports that the rural economy has actually done well as compared to the urban peers. Do you think that we are still in early days as far as this statement is concerned? Because we still haven't seen the burst of summer and the the monsoons are still a bit far away from here. So that narrative could also change. Let's say 3 months down the line or 4 months down the line.
So normally, Puneet, by ahead of election, we do see government spending picking up and also political party spending. Normally, this goes to the bottom of the pyramid, and their propensity to spend is much, much higher. So there is definitely recovery in rural economy. This is one of the rare quarter in last, I think, 8 or 9 quarters where most FMCG companies have talked positively about rural economy. They are all seeing sign of green shoots, whether it's two-wheeler, whether it's FMCG product, whether it's consumer durable product. So let's hope and pray that after a couple of false starts, this start is for real. And more importantly, what happened earlier, we build a momentum and then momentum
Tremendous.
kind of fizzled out. But a good monsoon could push that momentum forward.
So the next big thing for the markets, I believe, is the budget. And the government also said that it could be a big bang budget where, well, the third, it will unleash reforms for the in Narendra Modi led NDA 3.0. What are your expectations from the upcoming budget? What kind of
So one,
policy reforms could be unleashed, and what sectors probably could get priority?
just keep on doing the good work which you have done. India is moving towards path of fiscal prudence. Ahead of election, the vote on account talked about 5.1% fiscal deficit. That's very, very important. Second, there is a large amount of Indian savings frozen in gold, lying in tijoris of people. Gold prices have gone up. The wealth effect of gold is probably 300 to 600 billion dollar in last 12, 18 months. But people are not able to feel it because that's lying in their tijori. How do I bring this wealth effect out which can support consumption? How do I unfreeze the savings, this locked money, so that it can support investment? I think if we can manage India's gold conundrum, it can boost consumption, it can support investment, it can change India's growth orbit to double digit. When people talk about how financial liabilities have gone up, they don't realize that the mark to market appreciation of gold alone is more than the financial liability.
Is it time to dabble into equities directly, or would you recommend people go to the SIP route, given how the markets are likely to play out, let's say in the next 1 year or so? Is it time to play safe,
So,
or is it time to go all in?
Puneet bhai, if you are experienced investors, and I will say experienced risk-taking investor means one person who bought during COVID period. If you were net buyer in equity market in early 2020, you are experienced, you are risk taker, you can go all in because you know how to manage volatility. Now, whether you should go all in today, after 6 days, 10 days, that's your call. Which sector, you know what to do. But if you are inexperienced, you didn't buy during COVID, or you actually sold during COVID, then please don't buy SIP into mutual funds. You are inexperienced, your risk appetite is not sufficient, and hence it's better that you deal by a professional. It's as simple as that. मुझे गाड़ी चलानी नहीं आती, so I have to go with my driver. My wife is a rally driver. She can go on her own wherever she wants because she knows how to drive. मैं अपनी वाइफ को कॉपी करने जाऊंगा तो एक्सीडेंट कर बैठूंगा. I have to know my limitation. I can't be my wife. She's a rally driver. I don't know driving.
On that note, thank you so much, Nilesh, for your time today. We hope to see you soon.
Thank you, Puneet bhai.